Hello, and welcome to the Thriving and Volatile Markets live event. I'm Scott Nelson, founder of Thrivalist Strategies, and I'm excited you've joined me to talk about this very timeless topic. Why am I presenting a market volatility session when markets are continually hitting all-time highs? Well, in 2020, we saw a 10-year bull market disappear with a 30% correction in less than a month, followed by a market rebound that was just as inexplicably quick. Between the recent COVID-19 pandemic, politicians arguing over stimulus packages, and the recent election, we've seen extremely tumultuous markets in the past year. On top of that, we're all having to deal with fears over illness for our own health and our families, job losses as a result of the crisis, and just frustration at not being able to live our lives how we're used to. Second, I want to encourage you and remind you, we've individually and as a country faced crises before. In the past, we've come out better and stronger for it. Amazing innovations come out of difficult times, and we saw the same in this current crisis. I truly believe there's a lot to be hopeful in the future. Just think about last year. 6 years worth of innovation was crammed into 6 months, and we keep on talking about a new normal. But what is that new normal? Are we ever going to go back to the way things were before? All these amazing technology advances have happened. Are we going to just forget about them and go back to business as usual? Or are we going to innovate and move forward and be better for it? Those who embrace challenges like this one head on and reinvent or reimagine, those who innovate, will not only make it through this challenge, but will thrive. I know that there is what I like to call a Thrivalist within each and one of you. Someone who doesn't simply survive, but they thrive. Today, we're going to be talking about how we can help you thrive, not just in this current market, but any type of volatile market or crisis. It's my hope that you'll be able to come out of this live presentation feeling like you really understand how the market behaves, and you know what to expect from it, so you can prepare for every possible scenario. When we build your portfolio, we prepare for a variety of scenarios on your behalf, but we want to ensure you're right alongside us every step along the way. To that end, we're going to explain how market volatility works, and we're going to spend some time talking about how we as humans and our brains tend to react to volatile markets. This is based on research from behavioral scientists who've studied our brain, and which parts of it are activated when money's involved. We'll also talk about how we plan for volatility, and how we partner with you to help your plan stay on track to the best of our ability, no matter what the markets are doing. Let's get started. First, let's talk about why volatility exists and how it acts. If you were walking along and this bear jumped into your path, what would you do? Most of us would want to run. I certainly would. But contrary to our natural instincts, wilderness guides say to lay down on the ground and play dead. There's no way to outrun, outswim, or outclimb a bear. So your best bet is to face it down by lying on the ground. The same is true of bear markets. By fleeing, you might only make the situation worse, but by facing it down, you'll be well prepared to make it through. My industry is very highly regulated, and my compliance department had a field day with this slide. I almost feel ridiculous giving you this quick disclaimer, but I by no means am advising you to go out and face bears, nor do I advise you on how to deal with a bear. Bears are best avoided. Something I want to acknowledge up front is that investing is stressful. While the saying goes that money can't buy you everything, we all know that it's not about what you can buy, it's what the money represents. While it may represent something different for each of us, I would like to think we can all agree that no matter who we are, money represents our future, how much flexibility we have, how many choices we have, and how much freedom we have. Flexibility, choice, and freedom to live our lives the way we want. With all that tied up in our money, it's a wonder any of us are willing to put our money into an investment account. So why do we do it? We all know that just stuffing it under our mattress or into a hole in our backyard means it will lose worth over time due to inflation. That's just the nature of the world we live in. And now, with very few pensions left and longer lifespans, we have to fund our own lives for what could be many, many, many years to come. The only true way to do that these days is putting it in the stock market. That's why we're all here today. We invest our money to help protect against inflation. so our money doesn't lose value, and to potentially grow funds to help us fund our future retirement or other future goals. We also know that the market isn't just going to keep going up all the time, unfortunately. I wish it were, but actually sell-offs are needed in order for us to make money. Let's talk more about that. You've likely heard the term before, but what is volatility really? Simply put, it's changing stock prices. Sometimes they can change wildly from day to day or even in a single day. For example, one company's stock can start off the day at $5 a share and end the day at $10 a share. Or worse, it could start the day at $10 a share and end the day at $5 a share. When you're invested in multiple stocks, which is what mutual funds or exchange-traded funds allow you to do, this can be unnerving. When you see your fund losing value throughout a day or a week or a year. However, this is one way you and other investors can make money, so it's necessary. For example, let's say you buy a stock at $1 a share. Over the course of a month, it goes up to $10 a share, but the next month it plummets down to 50 cents a share. You get nervous, right? If you're continually investing, you get to buy more shares at 50 cents instead of your original price. Then over the course of several months, the stock goes up to $5 a share. You've made money. Even though the stock price went up and down wildly, in the end, you came out ahead. This example reflects an investment technique called dollar cost averaging, which also means you purchase a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. As a result, you end up purchasing more shares when prices are low, and fewer shares when prices are high. When implementing this strategy, it's important to consider your ability to continue purchasing through fluctuating price levels. Keep in mind, this strategy does not assure a profit and does not protect against a loss in declining markets. When it's happening, volatility can make us all nervous, but it's important to remember that it's common and has happened all throughout history. It's also often unpredictable, meaning trying to buy and sell at specific times to take advantage of price swings is very difficult, if not impossible to do. Simply put, volatility happens because investors try to hedge their bets. They want the best deal, and they want to make as much money as possible. If it looks like stock prices might decrease, investors sell to try and make a profit at the top of the market. If things are looking good and the future appears bright, investors buy. They think their investment will only go up in value. Investors and markets they invest in prefer stability. Stability means things are likely to continue as they have been. When there's instability, investors get nervous and sell. They think things aren't likely to get better, so they try to get the most money by selling today. As soon as investors anticipate things are going to get better, they buy. They think a deal is on the horizon. This tends to happen when there's clarity around the economic environment and the future. Let's talk a little bit more about what causes volatility and help you understand it. There are several items on the screen, but really anything can cause volatility. Some things make sense. For example, if you're looking at individual companies, their financial performance impacts how much they're worth, and thus how their stock prices. If a company doesn't make as much money as they expected, their stock price will go down. That type of price change makes sense, but a lot of times stock prices will change simply because of how investors are feeling about life. If they're nervous about life and the future, they may start selling a lot of stock shares, making the prices go down. If they're feeling good about life, they may start buying a lot of shares, making the prices go up. Anything and everything can impact how investors feel about life, politics, or the news, for example. People are unpredictable, which is why the stock market is also unpredictable. So what do we do with volatility? Well, first, we'll need to understand how volatility has occurred over history. If you understand how the markets have acted in the past, it can help put volatility in perspective. The markets have gotten very volatile with major upswings and downswings in the past, but in the end, they've historically trended upward. Secondly, it's important to remember that volatility is a common event in long-term investing. When volatility happens, remember that's to be expected and could be an opportunity for you. Thirdly, have a plan for both your investments, which it can help you with, and how you're going to handle volatility when it happens. Prepare yourself to see it in the markets and remind yourself what your plan is. Fourth, have a diversified strategy, which can help you weather volatility. We'll talk a little bit more about this in a minute. This chart shows how markets have performed historically. Despite always having volatility over the long term, they've trended upwards. There have been lots of times when the market is trending down. Without those times, there wouldn't be opportunities to purchase low-priced stocks and potentially make money in the future. When stock prices are low, investors have, in the past, seen the opportunity and purchased the stock, which has driven the price up, resulting in an upward trending market. Over time, prices can get too high, and investors sell, which may start the cycle all over again. While this cycle could change in the future, it makes sense that it would continue, because there likely will be always someone who sees an opportunity by investing in businesses and purchasing a stock that is a very low cost. And when the purchase happens, it helps the markets go up. Now, this is important to remember that everything we've looked at is showing how the markets performed in the past, and we can't know or guarantee what they're likely to do in the future. However, we know we can learn from history and apply it to strategies today. Throughout history, the markets have faced extreme crashes and dips, but it's always recovered. Up here on the screen are just some of the events that caused a major dip. As we said, what's happened in the past doesn't mean the future will act the same, but it's a good indication. Because we're human, when things are looking bad, we want to get out. But remember what we said at the beginning. The best way to deal with a bear, including a bear market, may be stay the course. By fleeing the market, when things start to get scary, you could miss out on the best days of the market. Just missing the 5 best days over the past 20 years would have reduced your investment returns by 2/3. And that's a common experience when you look at market history. What's interesting is that markets tend to have the best days and worst days close together. So by selling out of the market to avoid the worst days, you could also miss out on the best days. This is why timing the market is so difficult. You just can't be sure when markets will turn around. Just when you think things are going to get worse, that's when they could turn around and start trending up. Yes, there are forecasters out there who attempt to figure out the market and figure out when it's at the bottom and when it's at the top. But very few have gotten this right consistently, and none have always gotten it right. Staying invested does not just mean sticking your head in the sand, though. Just don't hold on to things that you know are losers and are trending the wrong direction. Keep your eyes open for opportunities, and be strategic about the money you're willing to put at risk. Think about the past year of market volatility. We had some truly terrible days in the market. Days when many of us thought things would just get worse and worse and worse. But then we had a couple major upswings, and at times the news still wasn't looking good. Why? Investors saw opportunity, but it wasn't predictable. Think about the dip in 2020. Things went down so fast, and we all knew it was going to come back. We just couldn't predict when. Clients, you know what I'm talking about here. We knew that the economy was like a race car going around the track, and then all of a sudden, you're winning the race, and something felt like there was wrong on the car. So you pulled the car over to the pit stop, and while they're trying to do the diagnostics and figure out what's going on and how long this problem is going to take to fix, the pit crew was putting rocket fuel in your engine. That rocket fuel was the trillions and trillions of dollars of stimulus. So we were confident that whenever this market came back, it was going to shoot off like a rocket ship. But we couldn't predict when. We had some things we were watching for, but the idea was we needed to make some tactical shifts to make sure you're poised for whenever that inevitable comeback happens. Because if you're sitting on the sidelines for that first few days of the comeback, you would regret it and you'd probably never get that money back. Now that you've seen how markets react, how best days and worst days are often close together, making markets difficult to predict, you can see how going against what everyone else is doing could potentially be the better strategy. We all know the old adage is to buy low and sell high. But as a group, most investors do just the opposite of this. They buy when stocks are on the way up and sell when they're way down. In general, throughout history, investors get nervous and sell out, often right before the market has taken off. But when the crowd is fleeing the markets, by going against the flow and staying invested, you can potentially do much better in the long run. Now that you understand how markets tend to react, and you know volatility is going to happen, how can we respond to it? So what do we do with volatility? Well, first, we need to understand how volatility has occurred over history. If you understand how the markets have acted in the past, it can help put volatility in perspective. The markets have gotten very volatile with major upswings and downswings in the past, but in the end, they've historically trended upward. Secondly, it's important to remember that volatility is a common event in long-term investing. When volatility happens, remember that it is to be expected and could be an opportunity for you. Thirdly, have a plan for both you and your investments, which I can help you with, and how you're going to handle volatility when it happens. Prepare yourself to see it in the markets and remind yourself what your plan is. Fourth, have a diversified strategy, which can help you weather volatility. We'll talk about more about this in a minute. Investors who get nervous and pull out of the market when prices are dropping usually end up losing money for all the reasons we just talked about. The S&P 500 is one of the stock market indexes. It's a group of stocks, and watching their prices can tell us a lot about how the markets are doing. Over time, the S&P 500 had trended up. You see that the 30-year average is an annualized return of 9.96%. A lot of investors invest in a group of S&P 500 stocks. However, their returns don't match the index returns. Why? One reason is because investors often get nervous and pull out of the market. The end result is that they lose out on returns. For example, the 30-year average return for an investor is only 5.04%. That's almost a 5% difference. So you want to have a strategy that plans for volatility, and a mindset for how to handle volatility when it does happen. The moral of the story is to stick to your plan and stay invested to weather volatility. The plan I create with you is based on your specific timeline and designed to account for market fluctuations. If you commit to stick to that plan and continue to invest on a regular schedule, you'll be well positioned to work towards your goals. Nothing is certain, but sticking to your plan over trying to time the market is an appropriate approach for most investors. Now that we've got our history lesson, let's look to science to understand how we all react when money is involved. One approach I considered exploring was from the great philosopher Homer J. Simpson. During one of his TED Talks, he was recalling an internal conversation he had. It went something like this: "Brain, I don't like you, you don't like me. Let's get through this together, and I can get back to killing you with beer." So that's one way to approach this, but let's take a look at how the scientists approach it. Most of us probably think that because money is related to math, it involves the logical part of your brain. But scientists have found that the opposite is actually true. Money activates the emotional part of our brains, the amygdala, or the lizard brain. The lizard brain is the one that simply reacts and responds to external stimulus without pausing to consider the facts. This happens to all of us. We can't help it. It's simply how our brains function. The lizard brain activates the fight or flight response, and it does so immediately. It sees a threat and aims to mitigate it. So that means if we're losing money, our fight or flight response is automatically activated. Driven by emotion, we feel the need to do absolutely anything to prevent the loss, even if, when removed from the situation, we might make different decisions. What do your emotions drive you to do when it comes to investing? Well, for most of us, if we see dollar signs, we want to buy. We feel the rush of excitement and possibility. But if we see loss happening, we want to sell. We feel the rush of fear of losing our future. And just as we discussed, both these are an opposition of what we know we should do. Our lizard brain does not help us make wise investment decisions. Something that is really exciting is that you can actually train your brain. Isn't that amazing? You can actually force it to go against its wiring. Think about creating a new habit. After you consciously choose to do something over and over and over again for several days, you'll eventually do it automatically. When you do this, you're actually creating a new pathway in your brain. You're changing your brain. To do this, you want to activate the logical part of your brain, your prefrontal cortex. By using that part of your brain, you can train yourself to remove emotion from the equation. How? Use this part of your brain to plan ahead of time how you react. Recognize how your brain wants to react and decide that you'll go against it. For example, if you know that your emotional brain will drive you to want to sell out of your plan, acknowledge this and decide ahead of time that you will not do it. But this is hard to do. It's going against ancient wiring. The way to do this is to have an accountability partner who you empower to help you stick to your strategy. You can choose a spouse, a friend, a family member, or your financial advisor. But whether or not you want me as your accountability partner, I am here for you. I'm here to be your coach to help you through difficult markets and help you stick to your strategy. There's a Vanguard study out there called Quantifying an Advisor's Alpha, and they've determined that an advisor has the potential to add 3% in returns to an investor's portfolio by being an accountability partner and a behavioral coach, simply reminding them of their long-term strategy and commitment to staying invested. That's what I hope to do for you. Now that you know how the markets act and how your brain wants to react, let's discuss how we can help you plan ahead of time for volatility so you can train yourself to stay the course. First, remember the strategy is based on you, your goals and needs, whatever they may be. Your strategy is based on your goals, your timeline, your risk tolerance, and we aim to reach your goals when they're certain, and we don't aim to reach specific market performances, which is uncertain. This is actually important to keep in mind because others out there may simply want to invest to get the most money possible. But that's not the best approach in my mind. That's because reaching for the most may not be necessary and it introduces unnecessary risk. We try to figure out how much you need and then reach for it in a responsible manner. We also invest for your risk tolerance. We want you to feel comfortable with the amount of risk you're taking in your portfolio because nothing is certain. Let's review what risk means. Risk really is the chance that an investment's actual return will be different than expected. It means you have the potential to lose some of your investment. I like to think of risk tolerance as how much future returns are you willing to give up for some extra safety? How smooth of a ride do you want versus going top speed at all times? Low levels of uncertainty, low risk, are associated with low potential returns. High levels of uncertainty, high risk, are associated with high potential returns. We use a strategy that fits your view on the risk-return trade-off. Part of our onboarding process for every new client is to have them fill out a risk profile with some simple questions to get their feelings on risk. And we check back in on this a few times a year. I've noticed some people really aren't honest with themselves about their risk tolerance until they've experienced the ups and the downs of a complete economic cycle. We also diversify. To review, diversification simply means you have different types of investments in your portfolio. Investments from different asset classes do not perform the same during different market environments. For example, stocks tend to do well when interest rates are low, whereas bonds do well when interest rates are high. But that's just one example. There are many different investment types and market environments. Since no type of investment always performs well, by combining different types of investments, they can compensate for each other. When one is doing poorly, another may offset it by doing well, and vice versa. The results can be a portfolio that may have less dramatic price changes. Now, diversification can never completely erase volatility, but it can help manage it. Now that you know how markets act and how your brain wants to react, let's discuss how we can help plan ahead of time for volatility so you can train yourself to stay the course. Our first step is all about you. We want to build a strategy that fits exactly with your goals and falls in line with how you feel about investing. To do this, we'll take a lot of time to discuss what you want your money to do for you. If you have an end sum in mind, and when you need more money. We'll also talk about your risk tolerance and how you tend to react in response to loss. This will help me decide what type of strategy makes sense for you. Next, I'll build an allocation for your portfolio that aligns with your timeline, goals, and risk tolerance. As part of this process, I'll decide with you if the portfolio will use passive or active investments. That means whether or not the investments are left alone or actively traded. I'll also decide, based on your preferences, if we'll take a more long-term view of the allocation, which means we won't trade it much, or we'll take a shorter-term view and we'll trade it more often in response to what's happening in the markets. Lastly, I'll decide how to diversify the portfolio and manage risk, balancing different investment types that don't act the same to compensate for each other's strengths and weaknesses. Once I've built the allocation, I then research the world of investments to determine how best to fill out the allocation. I try and be extremely fee conscious and pick low-cost, great investments between the universe of stocks, individual bonds, institutional mutual funds, exchange trade products, and even some structured products as well, to add some hedging on top of the growth potential. As an independent advisor, I'm not restricted to any specific products, and there are no proprietary products forced upon me. I choose those I feel are best in class purely based off my research. I spend days and sometimes weeks researching the investments I use to fill out your portfolio allocation. I have a lot of resources available to me to help me do my due diligence. I'll request materials from the actual investment companies, review their past performance and future projections, and often we use materials from LPL Research, who dives deep into many of the mutual fund and exchange trade product companies and provides me with additional information. Once I know which investment I'm going to use, I'll fill out the allocation with the right mix, which results in your unique portfolio. The recipe for your portfolio is on the screen. The performance-based funds I select, balanced for the amount of risk you want to take on, combined with your goals, equals your strategy. Now that you know how we build your unique strategy, it's important to understand how we plan for and anticipate market volatility. Your strategy fits you, your goals, risk tolerance, and timeline, and the strategy will be designed to behave a certain way to align with these goals and needs. It will track to specific benchmarks, not specifically the market indexes you see in the news every day, and it will help track you towards certain goals. While it will be designed to weather a variety of market environments, it will still experience dips and spikes. Just how big those dips and spikes are will depend on your risk tolerance. Let me explain what all this means by using an example. Let's say you're very conservative and primarily seeking income. We'll build a strategy that aims to trend up very slowly and have fewer dips and spikes, so a steady increase. You may not have large gains, but you should have fewer losses. On the other hand, let's say you're very aggressive in seeking gains. We'll build a strategy that aims to bring in high returns, but will also mean you'll see larger losses in the short term if the markets go down. We anticipate and plan for volatility in your portfolio, but it's always helpful to keep in mind what your portfolio is driving for and what your time frame is. Keep in mind, no strategy assures success or protects against a loss. That's not to say we just leave your strategy on the shelf. We continually review your strategy, and we'll make adjustments if your strategy isn't doing what it's supposed to. We'll also keep our eyes open for different opportunities as they present themselves. Now, that doesn't mean we're making sure your strategy is doing better than the markets. We're making sure your strategy is tracking with its stated goals. For example, let's say your strategy is designed to slowly trend up. If the market is down, it doesn't mean your portfolio won't go down. It just means you shouldn't be down as low. And if it is down as low, and is so consistently, it might be time to change. On the other hand, if the market is soaring, this type of investment will certainly go up, but won't go up as high as the markets have. The bottom line is, we'll monitor your portfolio to see if your strategy is performing how we expect it to during volatile markets. With that in mind, it's important to understand what your strategy is trying to do and to anticipate how it should act when we experience volatility. However, when volatility hits, you don't feel comfortable with how your strategy is performing, it might be time to review your goals and risk tolerance. It might mean that you aren't as aggressive as you thought you were. You can always reach out to us if you have concerns, and we can take another look at your goals and feelings about risk. In the end, our goal is to have a strategy that you're comfortable with and helps you work towards your goals. I know the past year has been a challenging one for all of us. The future may not be certain, but we're all in this together. I'm here to help you through whatever you need. It's times like these I really feel I can be most valuable to you. So I'm available if you want to discuss anything we've talked about today, or anything else on your mind. My job is to help you build a strategy that aims to work towards your goals, even when the outside world is going crazy, and to help you stick to it, so you can eventually reach your end objective.